Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
If you stretched out, you could stretch that all the way back to 1980, and you would see a steady decline in inflation until we got hit by the pandemic. We got hit by the pandemic and the policy response, so not enough supply and way too much demand. And then we got that doubled up again with the invasion of Ukraine. And those two things caused a temporary surge in inflation, but as you can see, it went away. Now, we're doing this again, I hope on a more minor scale, with the war with Iran. And that's also causing a surge in inflation. But beneath it, this is not an inflation-prone economy. So eventually, we're going to get to an equilibrium with Iran. We kind of have to. And that equilibrium is going to essentially mean that if everybody gets their oil out of the Gulf, Iran's going to get its oil out of the Gulf. And so I think we will restore supplies. The longer it goes, of course, the more damage to the economy. But ultimately, I think once that happens, I think you get oil flowing again, oil prices come down. I think tariff rates at the end of this year are going to be lower than last year. And I think that things like shelter costs, which were a big source of inflation in the last few years, things like apartment rents, those are actually backing off a lot. And so I honestly think that inflation could fall below 2% again in 2027. Maybe not quite by the end of 2026. We'll have to see how oil prices move. But by sometime early in 2027, I think you'll be down below 2% year over year. So I do think inflation is going to come down again. But between now and sort of the middle of the year, July, I think we're going to see some pretty rough numbers in inflation because of what's going on in the Middle East.
That's really interesting, the concept of an inflation-prone economy. And I suppose if it's not inflation-prone, is that because you don't see the consumer as being sufficiently robust to drive that demand-side inflation? Is it because of deflationary forces that have really been around for years? They've come and gone, or are other factors behind that?
It's three big deflationary forces that have been operating over time. So the first of them is that since the 1980s, the income distribution in America has been getting more and more and more unequal. The top 10% of households, they control 75% of the wealth. They control, by one measure, 50% of the income. And they get that chunk has been getting bigger and bigger and bigger over time. Now, why is that important? Because the big difference in the consumer behavior of the rich compared to everybody else is the rich actually save some money. The richest 10% save about 35% of their income. Everybody else saves zero. So what happens is when more and more money gravitates towards the richest households, that money then gets diverted to buying stocks and bonds instead of goods and services. And so you end up starving the markets for goods and services of demand while you're increasing demand for stocks and bonds. So that's why, you go back over the last 40 years, the average CPI inflation rate is about 3%. The average increase in the equity market or total return in the equity market is about 12%. So I think that's part of it. I think also the demise of trade unions, less than 6% of the private sector is now in a union. Workers just don't have the bargaining power to get wage increases. And then information technology. I mean, information technology helps buyers because sellers always know more about the thing they're selling than buyers do. But the more information buyers get, the more they're able to really enforce competition in markets they were never able to enforce it before. So, if you buy an airline ticket, you buy a shirt, you buy a book, anything that you buy, any good or service that you buy, you've got an ability to compete, may force the seller to compete in a way that was never true before. All these are very long-term forces, and they really have eroded inflation. And it took an extraordinary shock in terms of the pandemic and the policy response in Ukraine to actually give us a bout of inflation. We've now got a smaller but still extraordinary shock right now with the closing of the Strait of Hormuz. But ultimately, this is not an inflation-prone economy anymore. And if you take these shocks away, the inflation rate will tend to drift downwards.
And just before moving to what that means for interest rates, because I would imagine a non-inflation prone economy would give some leeway for a more lenient interest rate approach and certainly an easier approach to rates if we're not as concerned. I think this is behind the landmark, just more other pointers around food prices, all of this affecting that lower end consumer that you mentioned, and clearly price at the pump. So moving then to the Fed implications, we're in the middle of confirmation hearings. We know that there's a discussion around regime change at the Fed. And I'm not sure that markets or investors are particularly in the mood for a lot of regime change, having really got into a rhythm of knowing how to read Jerome Powell and the telegraphing that goes on there. And we're just back to having a few expectations of rate cuts in the consensus.